That takes us to our talk of the tape. Does this week's strong bid in both stocks and bonds have the bulls back in charge? And what should Wall Street expect in the early days of a new administration? Let's ask 314 Research co-founder Warren Pies. Warren, great to see you. Thanks for coming on and finishing the week with us.
Yeah, thank you for having me, Mike.
So, I mean, obviously Goldilocks, bit of an overused term, but it seems as if there was a pretty decent mix, the interplay between growth and yields and inflation this week. And I guess we had already had this internal pullback. What's your read on the week's action?
Yeah, I mean, I think it's very constructive. I think really the next few months is going to be dictated by the data. The Fed action, Fed policy is going to ultimately be responsive to the data. And we got some really important news. So the CPI came in cold. This is what we were expecting. I think you and I talked about this a couple of weeks ago. Shelter disinflation leading the charge. There was also reduced super core inflation. So that's positive on the fundamental side. It gave the relief on yields. You had Waller come out and kind of reiterate some sanity in the forward outlook for the Fed policy, in my view. And so that kind of calmed yields down, allowed equities to find their footing. In the background, I think this sell-off, we've now retraced, going back to January 13th, we retraced the entire post-election rally. And if you look at like some just bread and butter sentiment indicators, you look at like AAII, the spread between bulls and bears had gone from extreme bullishness right after the election to the most extreme pessimism that we've seen from individual investors since fall of 2023, when the market was making a significant bottom. So, yeah, I think it's been a nice sentiment reset, and I think the near term is going to be pretty constructive for equities.
Yeah, I was, mentioning earlier that it felt as if as we got toward the end of last year, there was a consensus building that it was a buy the election, sell the inauguration type of trade. That probably was a little too cute. We actually got the selling into the inauguration, sort of front-loaded it, I guess, after two huge up calendar years in stocks. But I wonder if, though, the acceptable range of, how fast growth can be, where yields can get to, exactly when the Fed might respond to all that is narrow at this point, because you did see we got a pretty good sell-off on that strong jobs number on Friday that had to be rebuilt this week.
Yeah, I think that's true. I mean, I do think we're still in a little bit of a tenuous position on yields. That's why I say I think the data is going to really dictate things going forward, because the data is going to dictate the Fed, and the Fed is going to dictate the bond market, contrary to kind of what I think has become consensus out there, that the bond market is moving contrary to the Fed. So, yeah, I think there is a bit of a narrow window, but, I think CPI was so important, and Waller coming out was important. I think it gives us at least a clear runway where yields won't go back to, I think, above 4.8 for the next bit of time. We're going to at least consolidate this move. And if you look back kind of to the things we've talked about in the past, I think really it is a lot of times for the equity market, it's about the pace of the move higher in yields that gets the market in trouble. And so if we can consolidate this move, and then we look back to where we were at the last time the market was at 6,000 post-election, yields were much lower. So even though the market's back here at 6,000, yields are a little higher, but it's been a little bit of backing and filling and rearranging sentiment at the same time. So I think that's a good roadmap for the time ahead until we can get more clarity on Fed policy.
Yeah, you could even dial it further back and say, at one point we thought 3% on treasuries on the 10s was insurmountable. Equities couldn't handle 3.5. I mean, all the way up, you eventually make your peace with that level if nothing breaks along the way. You've mentioned Waller a couple times. Let's actually, hear what he had to say and perhaps why it struck the market as fresh information.
We got a shock with inflation in January and February. They kind of put us back in terms of our progress for cutting rates. I'm hoping that doesn't happen again, so that if we continue getting numbers like this, it's reasonable to think that possibly rate cuts could happen in the first half of the year.
Yeah, which is funny because, if a month ago with the S&P 500, let's say 1% up from where we are right now, if you said maybe we have a rate cut in the first half of 2025, it would have been taken as bearish. And now, all of a sudden, this is actually seen as a sigh of relief.
Yeah, absolutely. I think the sentiment has swung so much on the bond side. It's kind of ridiculous to watch. I mean, you had people screaming for emergency rate cuts back in the summer and now saying we don't think we're going to have any cuts from here, and the Fed's probably done. Maybe the next move is a hike. I mean, I think, and Waller has taken some heat from what I've seen on social media and stuff, but I think he's really kind of the bellwether for the Fed. And so if you go back, this whole big market rally that started with a Fed pivot really began in November of 2023. And it began with a speech that Waller gave where he said he was more or less ready to consider a real Fed funds rate regime for policy. And that was like a turning point. You know, we got much more bullish on equities at that point at 314 Research. And so I think it's really good to have him coming out and expressing this view. It aligns with what we think. We see 4 cuts out of the Fed this year. Yeah, I think the path could be a little bit bumpy here in the first half as we get into Q2. But it makes sense. What he said aligns with everything that we believe that CPI is likely to move lower. I do think he also highlighted the risk that last year we had residual seasonality in January and February in the data. And does that come back to bite us again this year? So there's a little bit of nervousness around the early year data. But for the most part, I see it exactly how he does. And I think it's reassuring to the market.